Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about trading in a range. Now ranges are something that a lot of people have trouble with, which can be a problem because the markets are in a range, 60 to 80% of the time. So it's something that you need to become familiar with. It's something that requires a good amount of practice because it feels counterintuitive. There's something about it that, as a human, it just feels wrong, right? Like, why would I do that? So it requires a little bit of practice, but a couple things to keep an eye on when you're talking about a range. First of all, how do you identify a range, right? How do you even know that it's in a range in the first place? So one of the big clues is when candles start overlapping one another, right? When we look at this overall move, we opened up the day with a great bull bar to the upside, followed up with another one, and then looked really, really good to the upside, starting to break out. But then we start running into some problems. It starts pulling back on itself, and that's not by itself that big of a deal because buyers will probably be buying into that. They'll be buying a little bit more. As long as it doesn't break that low, that's what a lot of traders are going to be looking for, assuming that this is going to be a trend day to the upside. But a couple things start standing out here. We start seeing a lot of wicks beginning to show up, wicks beginning to show up, wicks beginning to show up, and notice how the candles are overlapping one another. Now what I mean by that is you have a candle that forms here and then another candle that forms here. And if you look at the previous candle before that, it's coming down a little bit into it, and then this one's kind of coming up a little bit. There's a lot of kind of consolidation. It's getting stuck on top of itself. And even with this big blow-off candle, look how weak of a wick that was on the highs. That was not a strong bull bar. So it's starting to give you clues that although this initially started the day as a potential trend, it's starting to fall apart a little bit. Now, does that mean that immediately start fading everything? No, but it does give you a clue that you might want to be a little bit careful. Because now, when we start coming back up to these highs, what's the anticipation? Well, this is where a little bit of psychology comes into play. We know that buyers, based on the first three candles alone, will be buying into this. It was a very strong move that started the day off. So what are they doing? Well, they're probably buying here. I mean, heck, they probably bought that big bull bar up there. They're buying a little more once it starts dipping down, buying a little more, buying a little more. They're buying all of this move down with the assumption that as long as it doesn't get below that low that formed at the open, at the 9:30 open, it's fine, right? But when we start looking at the bear candles coming down, now we have 1, 2, 3, 4 consecutive bear bars when all it took was 3 to get them to go long aggressively. So they're running into a problem, right? All of the people who are net long now need to start looking to get out. And where are they going to look to get out? Well, they're probably going to look to get out at the high or a retest of their initial entry. Now, why would they do that? Well, getting out at their initial entry point, that was the highest point at which they entered that the market went. So it doesn't really make sense to try to make any money on that because then you're kind of forcing the market, especially after we're getting these kinds of clues. But, right, they're making money on the others. So we have a break-even trade. We have profit on this one, on that one, on that one, and that one. So they're still well into the green, but they're exiting everything on that initial entry that they had at the highs. Now we can see that actually taking place. If we zoom in a little bit closer here, we can see their entry point. If they bought the close of that bull bar, guess what? All of that wick showed up. Now, why do you think all of that wick showed up in the first place? Well, because they were buying into this dip, right? They were buying into the dip and exiting everything on a retest of those high closes that are their earliest entry point, right? That was their first entry point. Now, if it does happen to go a little bit further, this is where it starts really converting into a range. We have a failed attempted breakout. And again, a very weak bull bar. Now we're getting clues. It's further confirmed that we are probably in a range, but this range does still technically have a bull bias, right? We have a rising low now that is starting to break down now, but we are making higher highs and we're making higher lows. So there is still a slight bull edge. So we know that it's a range with a slight bull edge. What are we looking to do now? Well, we're looking to buy trap lows, dips, returns back underneath the swing, whatever, with a slight bull bias, right? That's the concept that we're looking for. So when we have this move, when we start looking at this move up, big exhausted blow-off candle, and proof that we are starting to turn into a range, this is another blow-off bar. Buyers will start coming in below that bull bar with the understanding that we're now converting into a range with a bull bias. And they start buying for scalps. Comes back again, they start buying for scalps. They're exiting above bars, and there'll be traders that are fading these highs again once it returns back to those highs. Since it failed, they're starting to transition out of the rest of their positions and causing the market to drop. But notice every time we have a potential swing low, or this one hasn't tested yet, or a big blow-off bar, they all bounce back. And that's because buyers are buying into them with the assumption that we just talked about. It's a range with a bull bias. Now, it is starting to break down a little bit further, but it still hasn't really gotten down that far. And there are, I guarantee you, going to be buyers underneath this low that are looking to do the exact same thing that they've done on all of the other moves. So that's really what we're looking for when we're talking about ranges. Other times it's a little bit more obvious. You know, yesterday, or Friday in this case, we started the day off with a strong bear bar, immediately reversed into a weak bull bar, followed up with an inside bull bar, inside bear bar, failed breakout low. I mean, this is very obviously a range. So any break above the high or low of this little congestion zone is going to get faded. If you're not familiar with what faded means in this context, it means going against the breakout. A bull breakout would then get sold because they're trying to fade the move back into the original range. So where are they going to sell? Well, they're going to sell the high, but they could also say, well, you know what? This is the S&P, and an average scalp distance is about 4 ticks, right? A lot of scalpers go for 3 or 4 ticks on a scalp for the S&P because that's 1 point. We're humans, and psychologically speaking, it's nice to say, oh yeah, I got 1 point. It's just one of those things. So what's a logical area of interest then if we know that they're going to be fading the highs of this area, right? If we know that the beginning of that range was right there at 71.25, add 1 point to that, that's going to put you at 72.25, and that's going to be where a lot of traders begin entering in. Now, it did actually make it even further up to 73.25, so they actually had a couple chances. But just utilizing this information and saying, okay, well, sellers will sell here, they're going to sell more there, they'll sell more there. They'll sell 1 point above each one of those because they know that this breakout is very likely to fail. Now, this is where things get really interesting because notice all of these entry points, right? This one right here, 1 point away and 1 point away. Notice how every single one of them became an area of support or resistance, right? Now, why would that be? Well, that's because a lot of orders are transferring hands in those places. Buyers thinking that the breakout's going to succeed, low probability, and sellers who don't believe that the breakout is going to succeed, it's going to fail right back down again, high probability. All of those orders are switching hands back and forth, back and forth, back and forth, and it's a range. So the candles are already stacked up on top of one another, so we end up with a fist fight in these areas. It aggressively broke through this zone. It hit the next one and this one, all in one big blow-off candle. Well, guess where they're going to be selling? They're going to sell every single one of those, and a lot of sellers are going to have attention on this 5-minute bar's close because this is an exhaustive blow-off. This is the biggest bull bar that's happened all day at that point in time, and it's trying to break out of a range. Doesn't really sit good, right? The overall bias is that this breakout is going to fail and sellers will immediately slap the sell market button on the close of that candle and it fades all the way back down. Now put yourself in a seller that sold here, sold more there, sold more there. Where are you looking to exit? Probably at your initial entry point, like we talked about before. And you start getting all of this, look at all of this chop and slop around that break-even point for the first entry, right? You have their first entry here, second here, third here, and they exit everything on the first. That means that they make 1 point here and 2 points here, and this one's break-even. So it's a scratch on the initial position and a profit on the final 2. And you end up getting this chop and slop consolidation inside of here while all of these traders are now repositioning again for the same reason. So when you're looking at a range, you have to think where the probability lies. The probability will always lie in the fact that the breakout will likely fail. Eventually, the breakout will succeed. And that's where people get stuck because a lot of traders are going to be die-hard fade against this, right? Once you have this, yesterday is a great example when it finally broke out. Right? We have this breakout point above the swing high. It starts breaking out. Sellers will fade here. They're going to fade there. They'll fade the next bull bar. They'll fade that one. They'll fade every single one of them. Now, why do you think that when the market came back down to that original breakout point that it found a bounce there? Pretty interesting because all of the sellers who built in a position realized, wait a minute, this breakout has some staying power. This isn't like the other failed breakouts. This one actually stuck around. So when it starts edging back to their initial entry point or close, they're just going to slam the exits and get out, and it causes this immediate bounce back. So this context was a complete shift, and that's what you're looking for. Until something like this happens, it's a range, and traders are going to be looking to fade every single move that tries to break out of that range. Something to keep in mind, something to add to your tool belt. That's going to do it for today's training topic on ranges, though. Hopefully you found it useful, entertaining, maybe a little bit, something interesting, something to keep in mind when you're going through your trading day. Aside from that, enjoy the rest of the day. Hopefully you had a great trading morning, and we'll see you back at the 1 p.m. live trade analysis video on YouTube, live on YouTube. So make sure to tune in for that, and we'll see you all there. Thanks. Bye.